All right, so this is going to be a relatively brief lecture covering what we call the balance of payments. So this is covered in lesson 16. So we've already developed this simple model of trade to demonstrate how countries stand to gain from trade. And then we've talked about some kind of pros and cons of trade and different tools of restricting trade. But assuming that trade is actually happening between one country and other countries, then at the end of the day, we want to try and keep track of all of the goods and services that we're buying and selling, all the international flows of money. So what each country does is it builds what we call a balance of payments. And this is simply a record of all financial transactions, all economic transactions between the residents of one country and the residents of all other countries. So every country that isn't cut off from the rest of the world has its own balance of payments. Now, there are three big components to the balance of payments, and the first is what we call the current account. And this actually has a kind of a few subcategories. Now, the current account, the easiest way to think of this is simply our net exports, or X sub N, total exports minus imports. And we've talked about net exports with respect to our aggregate expenditures and aggregate demand. So we're going to track all of the buying and selling of physical goods, but also all of the buying and selling of services. So, for example, if I buy some tennis shoes from Canada, right, that would represent an outflow of dollars, and I'd be getting the tennis shoes. On the other hand, if I were providing some consulting services to somebody in China, right, I would be exporting that service, and then that would represent an inflow of dollars. And so we're going to keep track of that every time that an American household, person, business buys or sells something abroad. So, good balance and a services balance. But then in addition to the goods and services that we're tracking, we're also going to track just a few other flows of money. One is what we call net income. When people invest in other countries or they allow their resources to be used, the rents, the wages, the interest that come back or that flow out, we'll track those as well. And then finally, another category of transactions that we refer to as net transfers. So remember from our discussion of transfer payments that this is not payment for some good or service in exchange. It's simply a one-way transfer of money. And so the reason we keep track of this on our balance of payments under the current account is because sometimes we make transfer payments that go beyond our borders. So for example, when there's a disaster somewhere around the world, an American household donate to an international charity such as the Red Cross. That would represent dollars flowing out. Or if the federal government provides foreign aid to another country to deal with some issue. Those are both forms of transfer payments. But then also, especially in the United States with respect to our neighbor to the south, Mexico, we see a large number of dollars flowing out in the form of what we call remittances. And we've talked about these a little bit with respect to transfer payments. So for example, someone comes to the United States from Mexico, and they are working, they are earning money, they are spending money here. If at the end of the month they have some money left over, they might send it back home to their family in Mexico or wherever they came from. If I were to go to Canada and work and send money back to my family in Texas, that would be me remitting money back to the United States. So our current account, we're tracking the goods, the services, the net income, and the net transfers. So all of the dollars flowing in and out of the country that fall in one of those four categories, we'll take each of those subtotals, we'll add them together, and that will give us the current account balance. Now, for the United States, we actually have a negative balance. So in other words, we say we have a trade deficit. So when it comes to the goods and services that we're buying and selling, we actually are importing more goods and services than we are exporting to other countries. Now, a lot of people might think, oh no, a trade deficit, it's a bad thing. But you have to think about it in the form of, this is a two-way transaction. We may be spending money on goods and services coming from abroad, but what are we receiving in exchange? We are receiving those goods and services. So it's not necessarily a bad thing to have a trade deficit. It just simply means that your imports exceed your exports. Now, the other thing to consider is, in the case of the United States, when we have dollars that are flowing out because of our trade deficit, what happens to those dollars? And this is where we get to the second component of our balance of payments. It's what we call the capital account. And this is really going to track all of the buying and selling of assets. So this could be in the form of stocks and bonds or real estate or other property. Basically anything that's not a good or service and not just a transfer of payments but the purchase of something else other than a good or service. Now, like I said, when we have a deficit, meaning that we, the United States, send more dollars out, well, those dollars are going to have to come back in some form or fashion. Now, some of the dollars that we send out come back in the form of additional exports. So we may import goods and services from China, we pay them in dollars, and then they turn around and use those dollars to buy American goods and services. But at the end of the day, we know that we buy more stuff from China than they buy from us. So what are people in China going to do with these dollars? Well, they can use those dollars and purchase other dollar-based assets. So they could invest in American companies. They could buy bonds from the United States government. They could purchase real estate or other forms of physical capital. With other countries, we may be buying more of their assets, but on the whole, when we look at the entire capital account, the U.S. versus every other country, what we see is that the United States has a surplus on its capital account. And that makes sense because we have a deficit on the current account, meaning we're buying lots of goods and services and we're sending dollars out to everybody. But then at the end of the day, those dollars flow back in when we sell dollar-based American assets to foreigners. So at the end of the day, what we're going to see is that the current account and the capital account are effectively going to balance each other out. They're going to cancel each other out. If you have a deficit on one, then you would have a surplus on the other. So yeah, we have a trade deficit. We have a particularly large trade deficit with China when you look at it, a one-to-one relationship. But then we have to recognize that that's going to be offset, for the most part, by a surplus on that capital account. Now, there's one other component on the balance of payments. This is what we refer to as official reserves. And this just simply means to a government's holdings of foreign currencies. So for the example, the United States, in its bank account at the Federal Reserve, it has lots of dollars. But it's also going to have some holdings of things like euros or Canadian dollars or Mexican pesos or the British pound. And other countries around the world will also have holdings of foreign currency. So in China, in parts of Europe, in Canada, Mexico, their governments are going to have their own currency, but they may also have some holdings of dollars. And so we'll come back and talk about these official reserves in the next lecture on exchange rates, because we're going to see just very briefly how a country can use its official reserves to try and maintain its exchange rate. So, three components of the balance of payments. We've got the current account, where we're tracking mostly goods and services, but also some net transfers. We've got the capital account, where we're tracking the exchange, the purchase, the sale of assets. And then finally, we have the official reserves, the government holdings of foreign currencies. And what we're going to see is at the end of the day, if we take those three balances and we add them up, it should equal zero. Right? And especially if you think about, if you consider for a second, well, what if a country has no official reserves? So that would be a zero balance on their official reserves. Well, then you have just the current account and the capital account. And as we said, if a country has a deficit on its current account, that means there's dollars flowing out. Well, those dollars are going to flow back in the form of foreign purchases of American assets. So we'll have a surplus on the capital account that offsets that current account deficit. And then, of course, if there are official reserves, we would need to account for that. So if we take, again, the three components, current account balance plus capital account balance plus official reserves, and add those all up, we should get zero. And again, everything should be balanced out. And so we're going to stop this lecture right here. From here, I would recommend you take a look at the practice problems on the balance of payments. And if you have any questions, let me know.